Why do we see so much durable resistance at 50% of the 52-week highs on so many of these coins? Bitcoin right now is at 50.83% off of its 52-week high. Why is there so much resistance
I
there?
don't know. Humans are weird, right? It's behavioral. I want to buy it because it's down 50% to, oh my God, it's down 50%. I need to sell it. And the buyers meet the sellers. It's kind of, that's what we are. I mean, I use technical analysis because it's the behavior of crowds. And Fibonacci ratios, they work too. 50% is a Fibonacci number. So all of this stuff kind of works. I don't know whether the crypto market has another leg lower before it recovers. That's Tom DeMark's thinking that I've been talking to. He thinks there's another sharp sell-off. My personal view is I don't think there is, but who am I to question Tom? He's pretty good at this stuff. But it all matters. What matters is your time horizon. If your time horizon is 5 years and you're expecting a 10x or 20x, then a 50% pullback is well within a one standard deviation normality. And once you understand that, you stop fretting about all of this stuff. I have for a long time been talking about we can tokenize everything conceptually. NFTs were the breakthrough. That was the token that you can tokenize anything on. Mark Kahodis has talked about it using the T0 platform, but there's a number of platforms doing this. And what does this all mean? It basically means the breakthrough has been made to attach intellectual property or physical assets or digital assets to a blockchain in a method that is transferable instantaneously to anybody and storable and proven in its store. So using that, you can limit scarcity and also imply smart contracts. So the multiple uses of this are almost, we can't think them through. It'll change everything from the insurance business to the real estate business. It'll probably change everything from how we notarize things to the art world, to the music world, to how businesses are built using community tokens, which are basically a variation of NFTs. So that whole piece in the last week was trying to show that there are like 5 or 6 mega trends all converging around NFTs, and this is just the early stage. This is going to really break everything. I think the securities market will be attached to tokens, NFTs. I think we will find, all financial instruments will go that way because why? We can settle instantaneously. We can trade 24 hours a day, and it doesn't cost anything to do it.
Right.
So why the hell would you not? I mean, Sam Bankman-Fried's already doing this with FTX by tokenizing some equities.
Yeah.
We will see the tokenization of the asset management industry. That's all coming too. And it massively reduces the cost. Anybody who's ever set up a fund knows how painful it is. So this is changing, and there are whole platforms building these kind of businesses out. And this is not me pontificating on a Friday afternoon. This is me saying, I'm talking to all of these people, and this is all happening. And I'm involved personally in a whole ton of this stuff because it is incredibly exciting. I think people still think that DeFi was the big breakthrough. I'm a bit of a yawn on DeFi. It's like, yeah, great, yield. I don't care about yield. Price appreciation in a network model is worth more than the yield. When I look at NFTs, that's when I get really excited. And again, I'm not talking about collectibles. I'm not really interested in that market. Other people are, and it's very interesting, but it's not for me. What I'm interested in is, I think, a disruption of global business models, supply chains, and all of the things that can come with NFTs, and a change in the entire financial system that could be attached to this technology.
Well, that's exactly right. And I agree completely with that. The idea that all of the tokens that we're used to are fungible. One token equals any other token. You're happy to exchange it. Non-fungible tokens, the ability to include a digital fingerprint so that every token is unique. You can, at very low, in fact, near zero cost, effectively securitize anything, create ties to cash flows on anything, and create all types of residual ownership that was never before possible in human history. This is a big deal.
Just think about the complexities of the global derivative market. All of those are smart contracts that come on these big ISDA docs that are that thick.
Right.
And it's so difficult for the system to clear all of this stuff and know who owns the stuff, because I write a swap contract with you, and then you use that as the collateral for another one, and then somebody builds an option contract using the same collateral. It's so complicated.
Yeah.
This changes derivatives forever because each can have a unique NFT, and so therefore we can trade it and we know who owns it and what cash flows are built off it in terms of other smart contracts. So it just makes the world more functional.
Yeah.
It functions in a way that really aligns itself with the digital age we're now living in, where I expect to click on my Slack or Zoom and get you in 3 seconds and watch you via video. Well, the money system doesn't work like that, nor does the value system, nor does basically the entire world's contractual systems.
Right.
You know, it's stuff like insurance. 2 or 3 weeks ago, and I laid out this thesis that I thought bond yields were going to start weakening. Then I thought the dollar would start breaking higher, and eventually would spill into volatility in equity markets and in commodities. So what played out is bond yields broke lower almost immediately. They rebounded, tested the trend line again, and have started falling. My guess is that bond yields go to 120. They're currently at about 120, 130. I think they go to 120, maybe stabilize for a while, and then I think we've got a broader move to below 1%.
This is on the 10-year Treasury.
This is the 10-year Treasury. I use that as my kind of benchmark. Then looking at the dollar, we've been waiting for the euro to break the big head and shoulders pattern at 118, and it's tested it numerous times and hasn't yet. It feels that, you know, whether it bounces first and catches everybody by surprise or it breaks, but when it breaks, I think it's going to move pretty quickly. And that'll see the dollar rising. We're seeing a commensurate move in the JP Morgan Emerging Market FX Index, which is getting very close to breaking its uptrend. And I've said this before, when the dollar starts to move and bonds start to move, there's something going on that you need to pay attention to from the macro perspective. So the question is what is going on? So the narrative started that the Fed were going to tighten, they changed the dot plot. And that started flattening the curve, as it should do. But it kind of flattened a bit faster than people expected, which kind of suggested that the market wasn't sure whether the Fed could do this. And I've been eyeing the CESI, the Citigroup Economic Surprises Index, and started noticing that it was about to cross zero. Usually it trends, and we will see longer than expected weaker data. So if we're getting weaker data, then the bond market is probably telling us that we have a growth surprise, potentially to the downside. And the dollar tends to be a beneficiary of a low growth environment. It's not a rate-driven story, and the dollar rarely is a rate-driven story. So we're seeing real yields falling again, which has been helping gold, but gold has been trapped by the fact that the dollar is going up, and that makes gold quite unattractive. So it's kind of caught in these headwinds a bit. So what's interesting to me now is starting to see the data suggesting that the bond market is onto something. And it's the data that you talked about. Retail sales now are comping against the worst of the worst period of June, as are inflation numbers. But we've had real rises in goods, and they've been rapid, house prices. And we're seeing consumer confidence in all of these fall. So suddenly we're seeing confidence in purchasing cars, confidence in purchasing houses. All of these forward-looking indicators are falling because the price has gone up too fast that people are like, whoa, I need to stop that. Builders stop trying to build more property because the lumber price, okay, that's come off a lot now. But this is what often happens early stage after we're coming out of a recession. We have this fear that inflation's coming back. It's happened every single time since 1962. Bond yields rise. Everyone goes, oh my God, it's inflation. And what generally happens is the stimulus rolls off and the economy doesn't have traction yet. And that usually happens 2 times. The Fed actually usually ease twice after the end of a recession to allow the economy to get traction. And then eventually it stabilizes and the Fed can think about normalizing rates. I don't think they will. I think they proved last time that they can't, and the debt burden's just gone up. But we get to that more stable point in the cycle. So this point in the cycle here is normally when you see everybody check their assumptions. You often get a VAR shock in equities. You know, equities sell off sharply because, oh my God, growth's not there. Bond yields fall significantly. Usually they go to new all-time lows at this stage in the cycle. Does that happen this time? I don't know. And usually stimulus starts coming back on the table. Now, the political paralysis in the US might mean that it's hard to get across, and the bond market's not going to like that. If stimulus isn't coming, bond yields will start dropping further until stimulus comes, the QE comes back, then bond yields rise again, and we go through this cycle for a while. So look, it's a really interesting macro time. We're not 100% there yet, but we're close. Bond yields was the first thing to move. I'm next waiting for the dollar to make its move.